Hi, I'm Bill Blain, strategist with Shard Capital here in London. Here we are at the beginning of April, markets developing quite nicely. There is something of a concern. Markets do feel under threat, despite the fact that this week we've seen possibly the most heavily demanded Eurobond of this year. The Saudi oil company Aramco has launched a new multi-tranche deal and has attracted over 100 billion in demand for the paper. Now that is an extraordinary amount of demand from global investors who over the last year have seen a stream of negative news stories about Saudi Arabia. There's been the concerns at how autocratic the ruler of the country, Prince MBS, has been. There's been the Khashoggi murder. And then there are the rising political event risk concerns about how Saudi is going to cope in a world with less oil. Can it move itself into a more tech-led economy? There are big doubts in that, but despite that, we've seen this demand going largely into the long end of the bond. It's an interesting market. Elsewhere, markets do feel to be under something of a threat. If you're to read the analyst reports coming out of the investment banks, there are a whole slew of things we should be worried about. Apparently, the US earnings seasons, which starts this week, is going to be one of the worst on record. We are expecting US corporate earnings to be significantly lower, and that is going to seriously affect the future value of income, therefore should be a negative on the market. At the same time, we have Goldman Sachs warning that corporate buybacks of their own stocks are set to fall, and its buybacks have been one of the most significant drivers of the rally in the stock markets over the last year. We also have issues about liquidity. Liquidity is highlighted by many of the investment banks as the most significant risk. And by that, they're saying that if we see a downturn in markets, then markets will all go one way, and investors, as the proverbial story about the New York Stock Exchange tells us, will find themselves trapped. It is said that the New York Stock Exchange has 27 doors leading in, but only one door leading out. So if people all try and exit a difficult market at the same time, the result is always pandemonium. Now liquidity, the ability to be able to sell or buy a financial instrument, comes under threat, then we may see a significant change in the market. But what are the key things that are going to create an illiquidity issue? Well, one of the factors is one-way markets. If we get negativity in the market and a sudden slide, you will see people all trying to exit at the same time. And that's exacerbated by the number of investors who are now following tracker funds or ETFs that are simply agglomerations of a whole lot of different securities. If they all try and sell their holdings at the same time, the fear is that that will simply magnify the effect of liquidity and create an even deeper sell-off. And then, of course, there is the whole issue about who is making markets. Regulation following the last crash put heavy capital constraints onto banks, meaning that they've cut their market making. The inventory held by dealers in the fixed income markets is now less than 1/10 of what it was before the crash. However, I am beginning to feel that the concerns that the market has about liquidity are over-exaggerated. And one of the reasons for that is some very interesting research done by a leading investment firm in London that has simply looked and seen that banks are using the capital that they allocate to trading far more effectively, about 16 times more efficiently in terms of the number of times they are turning positions. So the market in fixed income has actually become more active rather than less active as the dealers have become more efficient. We are also seeing an understanding that liquidity is really just a factor of volatility. And this is absolutely critical, that if we see liquidity causing prices to fall, then of course that's when people come in looking for bargains and using illiquidity to equal opportunity. Now, one of the reasons that investors are so scared of illiquidity is regulators are constantly telling them it's a concern and are building it into investment mandates. There is now a behavioural bias to fear illiquidity, whereas illiquidity should be seen as a volatility opportunity. Thanks very much.